Alrighty. Welcome back to another exciting episode of the I Love Annuities podcast. I am your host, Jeremiah Conger, along with
Zachary Van Ness, and we are the Annuity
Dudes. Today's episode is going to ruffle some feathers. That's what we're here to do today. We're calling out the loudest anti-annuity voices online, people like Fisher Investments and others, and debunking the most common myths about annuities.
That's right. And we've all seen the headlines before. I hate annuities, or annuities are a bad thing. And we've seen it. But are annuities really that bad? Or is there more to the story? Do we need to find out more about annuities and how they can help someone?
Yeah, you hear it all the time. It's the A word. It's like there's taboo around the word annuity, and I'll give credit where it's due. And Wall Street and advisors that are biased in terms of them wanting to or preferring to offer investments like stocks or investment management like stocks and bonds. They've done a really banner job at really building a lot of negativity around the word annuity. But here's the spoiler alert for our episode. There's a lot more to the story. And by the end of this episode, you'll walk away with the truth so that you can make confident, informed decisions about, whether or not an annuity is something you should consider for your retirement.
Yeah, and what we're diving into is really what we hear. Oftentimes, we come into a meeting with a client for the first time and ask them what they know about annuities, how they found out about annuities or found out about us. And some of these things are just what we hear on a regular basis, or also what's out there, what may be pitched to somebody. And from our end of it, really kicking it off with the first one that I, quite frankly, hear quite a bit is annuities have high fees.
Yeah, that's probably the most common one that I hear as well, is that annuities are highly feed. We do a lot of content distribution on platforms like Facebook and LinkedIn, YouTube, so on and so forth. And one of the biggest anti-annuity comments we get, or the hate mail, if you will, is that annuities have high fees. The only people that benefit from them are the advisors selling them. And it's just a crock of crap. Like, honestly, that is what it is. And anybody that comments on that in that way, it's just a matter of lack of education. They don't understand the appropriate application of annuities and how they can truly help optimize an overall retirement portfolio. And I will say that there is some truth in a way that they have high fees, but not all annuities have fees at all. Here's the truth: is most annuities actually have zero fees. In fact, fixed annuities like multi-year guaranteed annuities, fixed indexed annuities, they have zero annual fees. You just earn interest, and that's it. And the only time there are any fees is if you elect to have a rider, which is adding another feature or benefit to the contract that oftentimes does include a fee for that feature. So we'll talk about some of those features here later on in the episode. But Zach, you can speak to the indexed annuities here. I think you have some more information about how those riders might work.
Yeah, really, when we dive into the fixed index annuities, they can be used in two ways, which we've talked about previously. So shameless plug to go back and check out some of our prior videos. But the fixed index annuity, you can use that for the intention of safe market growth, or you can use it for the purpose of guaranteed lifetime income benefit. So if we're really focused on where that fixed index annuity applies to an individual and that use, really from that end of it, if we don't have that income rider and those extra bells and whistles, there's oftentimes no fees that come with that. So compare that to an asset management fee of 1% per year. That's a requirement, no matter how your investment is doing. Annuities start to look pretty efficient when we consider there's no fees and you've got a guaranteed element with any annuity contract. There's a guarantee there, just a matter of what that guarantee is.
And that guarantee, I think, is worth its weight in gold. Not many other types of retirement vehicles can offer a guarantee. As a matter of fact, many have zero guarantees whatsoever. The only guarantees that you can find in this investment realm is found in an annuity contract, and it's pretty simple. And that guarantee, depending on the specific annuity type, is going to either be around lifetime income or a period certain of income, or a fixed rate of return each year. There's guarantees that can be had on that. And then in an indexed annuity, right, you can have a guarantee of principal protection so that you can rest every night. What do you call it, Zach? A sleep at night annuity?
That's it.
You
That's
can
it.
sleep, you can actually get more sleep at night, right? If because of that guarantee of principal protection where there's no downside risk to the markets. So it really makes you start to wonder, right? Like, why does somebody like Ken Fisher, the CEO of Fisher Investments, who has spent an enormous amount of marketing budget, marketing ad spend on bashing annuities. I mean, they are known for bashing annuities, and I think it's so ironic too, and really, um, I'll call it what it is. It's hypocrisy at its best. If you look up Ken Fisher's prior investment history, like what he's actually invested his funds in, he was a majority shareholder in an annuity company called American Equity. He literally owned a part of that company. So if he hates annuities so bad and thinks they're the worst thing out there, why in the world would he invest his own money in it? So, when you're looking at all of these annuity haters and whatnot, you really have to understand where they're coming from. And that's the thing that we strive to do here, is to know that human nature will never change. It's always going to be the same, regardless of the person or the industry. Human nature, for the most part, is the same and always will be. And that is when somebody has a bias against something, because it's against whatever they're bashing is against what they either believe in or, more importantly, what they actually benefit from. If you look at Fisher Investments, well, what are they? They're an investment advisor. They get paid to help people manage their investments and manage their money in stocks and bonds and other types of asset classes. So when they charge their fees on those asset types, those asset classes, and the funds that they're managing, they can't charge their fees on annuities. They also can't charge the fee on that bulk of money that's going into the annuity. So let's say someone has $1 million in their retirement accounts and they put in 50% of that money to an income annuity. If that money goes away from Fisher's custodianship and away from their management to go into an annuity, they can't charge that fee anymore on $500,000. That's a pretty significant loss of revenue for their company. So of course, they're going to hate annuities. However, if you go to show them any advisor out there that's telling you an annuity is bad or that they're highly feed or any of these other myths that we're about to debunk on this episode, if you can have them prove to you how they're bad, I would challenge that they're not going to be able to do that, because no investment advisor, including Fisher Investments, can guarantee a lifetime income stream for you and your spouse. No investment advisor can guarantee a fixed rate of return every single year. And a MIGA can, a multi-year guaranteed annuity contract can. No investment advisor is going to guarantee a principal protection, but an annuity can. And they can do this all within a written, documented contract. So for someone to say that annuities are bad, really what they're doing is they're using their bias to come up with that approach. And they're also lumping all annuities together, especially variable annuities, which are known and notorious for having high fees. Variable annuities, we've covered them in previous episodes. They're known to have anywhere from 3 to 5 different fees, and the fees can range when added up all together anywhere from 2 to 5% a year. Well, if you look at it from that perspective, you could say annuities are highly feed, but it's just one type of annuity, which is a variable annuity. So trying to pretend that they're all the same and grouping them all into the same bucket or whatnot, that's misinformation at its finest. And that's what we're here to shed light on.
Yeah, and I think what we find is that, yeah, maybe a representative from Fisher or another investment firm may have those statements that they can make and try to suggest annuity can or cannot do something. But oftentimes, what we find is the lack of knowledge that comes with that conversation. So that's why we've built the format that we've built and in producing these YouTube videos to bring that education to you so that when those conversations do come up, you're better educated going into it, and you have that knowledge base
I'm
already.
going to also add something else in there too, which, again, we're probably going to ruffle some feathers here, but I truly believe if you have your essential living expenses covered with guaranteed sources of income between Social Security, a pension if you're still blessed to have one, and an income annuity, a guaranteed income annuity. If you have that part of the puzzle solidified or that foundation for retirement planning solidified, why do you need an investment advisor? Like, you don't. In my opinion, you truly don't need one. I do believe you need a CPA. You still need to mitigate tax risk and ongoing tax risk as you move to and through retirement. So I'm not saying you don't need other financial counsel, but if you have your income plan solidified, why in the world do you need an investment advisor? And that's where Fisher Investments and these other firms that are against annuities and these other investment advisors, they're insecure because they know if you're able to solve the income problem in retirement, it makes their job that much. It's
Obsolete.
worth it. Yeah, it's obsolete. It's worth less. And the whole point of a plan is to keep you disciplined in the plan. That's what plans do. That's why they're important. And if you solve the biggest puzzle piece in the plan, and that's the foundation of retirement income, all the other stuff is easily managed on your own. Think of it this way. And I know that this may ruffle some feathers. That's okay. When you were working, right? When you were in your 30s and 40s, and probably even your 50s for the most part, did you have a financial advisor back then? Did you have someone telling you how to balance your portfolio or your 401k at that time that you were contributing every month? Most people answer no to that. Well, why? Why did you not have a financial advisor during your working years when you were accumulating assets? But now you feel like you may need one as you go into retirement. The common denominator there is that you had income during those working years. You had earned income in your 30s and 40s and probably your 50s. And if you go back, let's say 25 years to the dot-com bubble, I asked this to prospective clients. When that event happened, were you worried or concerned then? And most people say, no, not really. I was younger. I was still working. I had a good salary. And I actually was getting stocks at a discount. I was continuing to invest in that market. Well, when you go to retire, people fear, retirement and going into that new phase because they also are retiring their earned income. And so the security of and the stability of their existence and their lifestyle is income. So if you find an income annuity that can replace your earned income when combined with Social Security and a pension if you have one, and you can cover your essential expenses no different than when you were working, it makes you look at the rest of your growth portfolio completely different and allows you to stay invested so that you can ride the turbulence and ride the roller coaster and the ebbs and flows and ups and downs. The income is the puzzle piece. It's once you solve that, it's like when you take a puzzle out of the box. When you have an income annuity, when you take that puzzle out of the box, it's like half of the picture is already built for you. It makes it easy to put all the other pieces together at that point. That's the
Mhm.
beauty of the annuity. And that's why Fisher Investments and other investment advisors are insecure about people knowing about the good and proper use of annuities. Simple as that.
Yep. Yeah, so that feeds into really that first myth of annuities having high fees, and really just it's lack of understanding. And I think that's what we see across the board. There's a narrative behind it, oftentimes with larger companies, which would make you question if one company has one direct narrative around a certain subject matter. Um, how is it really affecting them? And that's affecting them in a poor way if somebody goes the route of an annuity. Um, so annuities having high fees, that being myth number one. Myth number two, annuities are too complicated and too complex.
Man, look at that. That's a cool board right there. If you're watching this on YouTube, you can see now we're sharing our myth versus fact board. Pretty cool there. But yeah, annuities are too complicated. That's really one of the other things that we hear sometimes from the annuity bashers of the world. But let's be honest here, like there is this industry jargon that can be intimidating, especially if it's new to you and you've never heard it before. Things like index crediting and surrender periods and riders. And it can seem pretty technical and it can get fairly complex if it's new subject matter. But let's be realistic here. So can mutual funds, ETFs. I mean, what is an ETF, right? Most people don't even know what that stands for. Structured notes. Anything with value is going to have some depth. So when you think of, some of the most prized possessions in the world, they usually have complexities around them and why they're valued at such a high level. If it was simple and easy, everybody would own it and it wouldn't be as rare and valuable anymore, right?
Right. Right. Yeah, and it's interesting because when we think about it, I don't, the last advisor I spoke with, investment advisor, basically just allocated that individual's assets, right? There was no explanation as to why what was going where or why this specific index over another or why this stock. Well, it's a blue chip stock. That's all you need to know. Really, what we're trying to build out is the understanding, which is, I think, what's lacking in that world, in that advisory world, where what we're trying to do is provide an understanding of these annuity types. And that's why we take you through that process. So, really, if you can understand, for example, if you can understand how a CD works, you can understand how the um, I'm sorry, how the multi-year um, guaranteed annuity works. So if you know what a stock index is, you can understand how a fixed index annuity works. And that's what we're here for. Really, we're just providing that education, that information first. And then if you find value in what we're talking about and see a fit for an annuity, we progress from there.
Exactly right. And at the end of the day, annuities are just contracts with an insurance company. So it's a contract between you and the insurance company, and they're going to provide either income, growth, or protection, or a combination of all three in certain products. And that's it. And so it's just understanding the terms and conditions of those contracts and those guarantees around those types of benefits with that insurance company. And when you get an annuity contract, like when you actually get a policy, they can be pretty lengthy in terms of the total number of pages. However, the guarantees and a lot of the meat and potatoes can be summarized and found in literally like 3 to 5 pages at most in those larger, policies. A lot of the pages are like just literally the terminologies and like the trademarks of the certain indexes that are being used and examples. Like they're required to give you what's called an annuity buyer's guide. So that's always lumped in there. And that's probably 12 or 13 pages.
Mm-hmm.
They're also required to give you examples of how scenarios work. And so they can seem intimidating, but at our firm, Annuity Association, our mission is to help consumers like you make better annuity buying decisions. Regardless of where you're at in your annuity journey, whether you're a novice looking for base level education, or you're intermediate or advanced to like an expert level, we're capable to help you in each stage of that journey to help you make more informed, educated, and confident decisions on which annuity is right for your particular situation. And if you really want to work with an expert that's going to work at your pace, not pressure you into anything, but really take the approach of really truly helping you evaluate all of the options on the market, compare them side by side. We're an independent annuity advisory firm that specializes in just that, and we would love to earn your business. So if you're interested in doing that, you can somewhere here in the description of the video or the show notes, you can always click the link there to book a free annuity discovery meeting with one of our subject matter experts. Or you can start with just a simple report request where we can provide a report curated to your specific situation, show you how we can help you. And then later on, if you decide that you want to meet with somebody, you can take that path to do so. But we would be honored to earn your business that way. But it's really just about the unpacking of the complexities. I don't really think they're overall that they're too complex. I think it's just most people, when they go to talk to somebody about annuities, and like generally it happens, where they go to a dinner seminar, or they go
Mhm.
to an educational workshop, or they go to, like, their friend is an advisor or an insurance agent that sort of dabbles in annuities but doesn't maybe know them wholeheartedly. Um, Most of the time, where the complexity comes in is the individual that you're getting your information from. They're not able to convey or distill down, break down these complexities to a simple, easy to understand manner. And that's something that we're passionate about. That's what we do. Um, so generally, that's what I hear the most is, oh, they're too complex. And I'll ask them why they feel that way. And generally they'll say, well, this person was trying to sell me this annuity, and they showed me this, and then but they couldn't explain what this meant. And it really, like, told me, if they can't even explain it, how am I to understand it ever? Well, that's just because you were working with someone that doesn't know them the way they should. And unfortunately, that's what most of those situations look like. But I can assure you, if you come to speak with an advisor of our firm, if there's a question you ask and we can't explain it to you, um, I will be really, really surprised.
Yeah, and let's call it what it is for the folks that we do talk to. I don't. It'd be interesting to see the statistics on it, but there's a large number of folks that we talk to who have met with an advisor already and have that exact sentiment and suggested this product. Income on it looks great, but they haven't been able to explain how we got there. And there's a question, there's a doubt in mind as to the information that was provided to them at that time, and they're seeking the education to better understand it for themselves.
Yeah, absolutely. So let's get into myth number 3 there, Zachary.
Yeah. So myth number 3, this one I would probably put this right at number 1 even. That myth being that you lose access to your money. And this is one that we hear, oftentimes from Fisher, is that your money is locked up in an annuity and you don't have access to it. You can't touch it ever again. It's locked away for 10 years.
Or even better, I just got this comment on one of our YouTube videos the other day, like literally like yesterday or the day before. And they said, annuities are a bad deal. Day one, you lose your money. Like day one, you lose access to your money. It's gone. The insurance company keeps it. If you die, there's nothing left. Like,
Yep.
that's one of the biggest myths. And quite frankly, anytime someone says that, I know for sure, without a doubt, they are uneducated when it comes to annuities. Like, it's a lack of education and understanding. Most annuities, when I say most, I'm literally referring to 99%. 99% of annuities, you do not lose access to your money. If you die, you do not lose your money. The only type of annuity that would ever be the case is the 1%, and that's what's called a single premium immediate annuity. However, it must be structured in that way. Like a single premium immediate annuity can be customized. You can
Let's
have,
define it too.
yeah, so single premium immediate annuity is a income focused annuity that can be used for either lifetime income for single, lifetime income for a joint, so you and your spouse, or it can be structured to provide guaranteed income, but for a period of time only. So it's not just a lifetime guarantee. It may only be paying you for 10 years or 15 years, and that's customizable. In addition, single premium immediate annuities can also have different structures in terms of um, what happens if you die. What happens if you pass away? What happens if you pass away earlier than later? You can have different structures or customizations where you might have, let's call it a 10-year period certain with a lifetime guarantee, or a lifetime guarantee with a 10-year period certain. What that 10-year period certain means that if you were to die within the first 10 years of the contract, even though you had a lifetime guarantee, that lifetime guarantee goes away, but the income amount, so whatever you were receiving monthly or annually, will continue to pay your designated beneficiaries in the contract for the remaining duration of that 10 years. So if you died in year 2, that income stream will continue paying your beneficiaries for the remaining 8 years. That certain period can be customized. It can be a life with 15 years, or a life with 20 years, or a life with 30 years. I mean, it's all customizable. And now understand that the more customization you make it to where it's a better deal for you than the insurance company, the less income they're going to pay. That's just the way it works. So the more risk you take, the better and more income you receive. So there's always going to be that risk reward relationship. Um, there's also, even in single premium immediate annuities, there are some with access to the money. A lot of people think all SPIAs, once you sign that deal, your control over that principal amount of investment is gone. That's not true. There are several SPIAs. One that comes to mind, there's one from New York Life, there's one from Nationwide,
Yep.
where they have a feature in them where if you add that feature in, you still have access to a portion of that money if you needed additional liquidity. So anytime someone says this myth, that you lose access to your money, or your money's gone, boom, it's vanished. Like, it's just a pure lack of education. And that's only really prevalent in one type of annuity structured in one unique way. So all the other types of annuities, you're going to have access to your funds through a free withdrawal. If you need more than the free withdrawal, you can still access your money. There just may be a penalty assessed on the amount above the free withdrawal allotment. So if you die in all the other annuities, 99%, if you die, whatever is remaining in the account value at the time of death goes to your designated beneficiaries. The insurance company does not, does not, does not keep your money. I can assure you that.
Yeah, but you've just included a lot of features there, so there's got to be a fee that comes with that.
You would think, right? You would think that there's going to be a fee, but that's not the case. There's no fee for that feature. This feature is built in to these contracts.
Bingo. Yeah, so just to sum that up, from that vantage point, again, it's just coming back to the education, right? So from our end of it, being an independent advisor, we have access to find a product that will fit and tailor suit your needs of what you need it to do for you. It's just talking it out, finding out the best fit for you individually.
Yeah, and then also there is a unique feature built into some fixed indexed annuities that's called a return of premium. Okay. The return of premium provision allows somebody, after a certain point in time of being in the contract. So most of the indexed annuities are going to be 10-year contracts. There are some that offer lesser terms, 5 years, 7 years, so on. The majority of the marketplace is 10 years right now.
Yep.
In those 10 years, there is a return of premium provision in some of those select contracts that state, if you fulfill the 5th year, you have the option to, if you don't like what's happened, or maybe you have a change of heart, maybe you're not happy with the performance, or maybe you are, but you have a different investment opportunity and you want to walk away, you can get a full return of your premium with no surrender penalties.
Yep.
So a lot of people just don't know about these additional features. But I will tell you, these products are built to address a lot of these myths. They're also built to address a lot of the pain points when it comes to decision making with annuities. So the insurance companies are starting to develop new features and benefits to address some of these, these objections, if you will. And one of those is a return of premium.
Yeah. And there's other things that come with that, right? So the big question that comes up is, well, what about surrender charges? There's, this is something that's included here where it's going to be putting me in a position where I'm losing money. Well, sure, surrender charges are there. And it's something that we talk through to better understand how this can affect somebody. Or maybe that term might be shortened up, like you had mentioned, 5 years, 7 years, or 10 years to mitigate having to be concerned about that surrender charge. But we've also got to consider is this isn't the only avenue where there's a fee or a charge associated with something. When we look at it, there's other things like withdrawal penalties on IRAs, CDs, or 401ks. So it's really just about understanding the terms, and that's with any route you go, whether that's an investment or an annuity.
Yeah, and just to speak real quick on surrender charges, a lot of times people wonder, like, why do those even exist? Like, why are they a real thing? And it really comes down to understanding the behind the scenes mechanics of the insurance companies and how they're able to provide the benefits of principal protection, market linked index growth with no downside risk, guaranteed income, so on and so forth. The way that they're able to do that is by securing large positions in bonds. And so normally what's associated with a bond is a holding period. Like you have to hold the bond to maturity. And so if the insurance companies on the back end of things are buying these bonds and those have a maturity period or a holding time requirement, and then they're building this product called an indexed annuity or a multi-year guaranteed annuity or whatever annuity, and they're getting people to buy those annuities. Well, if you decide to just walk away and get your money back through surrender, then the insurance company's on the hook for those bonds that they purchased. So in order to mitigate the risk of you not holding up your end of the agreement, they have those surrender charges in place. So it's in place to protect, the insurance company. That's ultimately what it is. But rightfully so, they're taking the risk and putting the money where it needs to be held for a period of time. And they need to assure that you're going to hold your end of the bargain too if they're taking that risk. So there is some trade-off there and some reasoning on both parties to ensure that they can provide these benefits and that everybody's going to hold that that contract to the term that they agreed to.
Yeah. And again, it just comes back around to understanding why these are in place and understanding the terms that come with that agreement.
Absolutely. All
Uh,
right.
Next myth number 4, annuities. Actually, I'll let you take this one, Jeremiah.
Yeah, annuities are only for people with limited retirement funds.
That's right.
Annuities are only for people with limited retirement funds. That is the one that I find the most humor in. And the reason that I find it funny, right, is because I have I have clients that are worth. I have athletes, professional athletes that own annuities. I have actors that have bought annuities from me. Um, Other celebrities, people with a good amount of money. I have people that are just like engineers that amassed a fortune. I was talking to you, Zach, earlier before we started recording. I have a client that literally shared his statement with me because he was putting an annuity in place and the carrier required a proof of funds statement. And the guy has 21 million in cash, just cash, not talking investments and real estate and all these other things. So to think that annuities are only for limited retirement people with limited retirement funds, it really goes again to more of a lack of education around the subject matter.
Yeah.
And I think it's crazy that people think this.
Yeah, and I think when we get back to what annuities capabilities are, what they have, it's the certainty, it's the guarantees of what's built into that contract. And really, it's basically everyone approaching retirement that's looking for some type of certainty and some type of guarantee. And that's where, yeah, I agree that the dollar amount of what your net worth is, that doesn't speak to the psychology of what may help you sleep at night.
And the other thing too, right, is that human nature doesn't change. Human psychology and the hierarchy of needs of people do not change. We talked about Maslow's retirement, or I'm sorry, Maslow's hierarchy of people, like the needs of people. And then we have that retirement hierarchy, which is income. That's the foundation. And human nature doesn't change regardless of how much money you have or what your net worth is. People still want security. In addition, the rich get rich for a reason. It's because they're good with their money, they're disciplined in a way, and they also understand optimizations. Optimizations. Like they understand how to do that, and they also know what leverage means. And so when you take an annuity, let's say you're a wealthy person, and we're stereotyping the wealthy here in this case, saying like, oh, they've got so much money, they don't need to care about guaranteed income. Well, what if that wealthy person wants to get even more wealthy long term, and they want to shore up their income foundation with guarantees that then can afford them to leverage the rest of their assets in riskier investments so that they can make more money? The risk reward relationship never goes away. To get more reward, you have to take more risk. If an income annuity is positioned to optimize the reward, they can get that foundation of income and then afford to take more risk and leverage the remaining assets to grow more their wealth even more. That's how they use it. And so when you look at it from that perspective, it makes all the sense in the world. And it doesn't matter what walk of life you come from. Us as humans, we all have the same needs, wants, and desires. We all want that stability and that security and that peace of mind. I don't care how rich you get. All of us want that. And it really comes down to understanding that basic human element of security, and that's what people associate guaranteed income with, is their security in retirement.
Yeah, it doesn't matter the assets that you hold, right? So we've talked to small business owners. There's a element there where they want some security too. And maybe that means giving themselves a paycheck so that they can now create another small business in retirement and have fun with it. Maybe more fun than what they had in their 30s and 40s when they were building a company. It could also mean the same thing for a nurse or an engineer or a teacher, just having that certainty so that maybe that means you go out and spend your time doing charitable work, not something that you have to commit to every day in your later years.
Yeah, and the other thing too is like the annuities, when appropriately, you know, when appropriately applied to a retirement plan, if we're talking income specifically too, it makes all of these people, teachers, you mentioned engineers, nurses, small business owners, whoever, athletes, I mean, you name it. It simplifies their retirement. Like it simplifies the most difficult equation in retirement, and that's how do they get their income once they retire? It simplifies that. It's like it's paychecks on autopilot. You don't even have to work anymore. I mean, you're still getting a paycheck every month or every 2 weeks or however frequent you wish to receive them. Um, we also call them play checks, right?
Mm-hmm.
It makes it simple to have fun and go spend your money leisurely. And those are called play checks, but they're autopilot. Again, it's done for you. And so one thing I always challenge people with that we speak to that aren't maybe sold on an annuity quite yet, and that is like, when's the last time you've taken a withdrawal out of your 401k or your IRA? Most people have never done that. So to think that they're going to just somehow miraculously be comfortable once they hang the boots up or hang their gloves up or whatever, and they're going to be able to now start hitting withdrawal from their nest egg that they've saw just do nothing but grow, grow, grow. And then when they start to click the button to withdraw, they see it start to deplete, deplete, deplete. That's an uncomfortable feeling, and especially if you've never done it before. And when you bring that up and you really think about the psychology behind that, it's hard. I don't even like going to the ATM and taking money out of my bank account. I mean,
Yeah.
I don't like doing it. I'm frugal.
Well, and if
So
we,
imagine having to do it every other week because
yeah.
you need income.
And if we relate that to something that may be an everyday occurrence, right? So if we go, Saturday morning, I get chores done so I don't have to think about it and I can enjoy the rest of the weekend. Well, yeah, if I've got to sit there for the entire weekend thinking about, I've still got these chores to do Sunday. Sunday comes, now it's Sunday afternoon. Crap, I got to get this stuff done. The weekend's almost over. I'm sitting there thinking about it constantly, not enjoying the weekend. Well, if I've got a plan in place going into retirement, I don't have to think about the stresses that come with my income check. It's already in place. I can enjoy retirement.
100%. And that's where it really comes down to understanding the utility of the annuity and what it's actually doing. And that's where that peace of mind element and that optimization comes in. And, again, applying annuities in retirement to address this myth here that they're only for people with limited retirement funds. Again, we've worked with people from all walks of life, anyone from 150,000 in savings to people with 3 million and above. And regardless, um, their needs are all the same. And it's not about being rich. It's about being smart with your retirement nest egg and optimizing it for peace of mind.
Yep. Let's hit on the last myth here, and that is that you'll get better returns in the market. So this is just the classic investor's myth or investment advisor's myth. Why buy an annuity when you can get better returns on the market?
I love this one. Like I got this one the other day. Another comment. If I just invest in the S&P 500, I'll get a 10% return a year, and I can just source my annuity, or excuse me, my income from that. And the response is, okay, sure, maybe you could do that, especially if we're in a bull market and that bull market still got some steam left in it. You might get higher returns, with the stock market and then be able to source your income from that. But doing that and taking that approach ignores three of the key retirement risks that are most oftentimes underspoken and misunderstood. And that is the volatility risk, more importantly, sequence of returns risk.
Mm-hmm.
And let's talk about the big one, the multiplier of all of the risk that we face in retirement. And that's longevity risk.
Yeah, without a doubt. And in annuities, especially fixed index annuities, for example, they're really built for that downside protection with a reasonable upside. And again, it's not about beating the market, especially when we're getting near that retirement phase. It's about not losing your shirt when things start to go south.
Yeah. And like maybe you're not, a risk adverse person in general. Like maybe you do have a higher risk tolerance than most people, even as you approach retirement. That's perfectly fine. It doesn't mean that an annuity can't still help you. And maybe you don't even need a guaranteed income annuity. What you can also use an annuity for, like a fixed indexed annuity, is a volatility buffer tool.
Mm-hmm.
In other words, let's say you want to take that bull market approach and say, "Hey, I believe in the markets here. Let's go ahead and let it ride." Sure, go ahead and do that, but at least segment a portion of your assets similar to how you would maybe put them into a bond position just to have a little bit more diversification and security for those volatile moments. But the indexed annuity and where it shines above and beyond a bond position historically is because of that guarantee of principal protection and zero downside risk. In those volatile years, you can choose to take your withdrawal out of the fixed indexed annuity. And I'm not talking about a lifetime income rider. I'm simply talking about a growth focused indexed annuity with no income rider. But because it has a 10% free withdrawal provision, If you can source your income in those down years from the indexed annuity, it can allow you to stay disciplined and stay put with the rest of your investment portfolio that's invested in the stock market. And in good years, you just take your income from the positive gains in the stock market. But in down years, you take your income from the indexed annuity. What's nice about it is that it's giving you that volatility buffer. It's like the wild card. Like if the markets are down, I know I can get my income from a place that's not going to force me to sell shares in a down market. In addition, when the markets are growing, so is that indexed annuity. So you're building a reserve bank in that volatility buffer for future long-term needs, and or death benefit, legacy, long-term care, leisure, whatever you wish to use it for. But it's giving you the ability to have a flex, and that's what we own the trademark OptiFlex, because that strategy gives you an optimization through that flexibility of where you withdraw.
Yeah, really. And looking at this, when do annuities actually make sense, right? What we're trying to do is we're trying to debunk these myths and these misconceptions and really get into understanding when these annuities actually do make sense. And they really make sense if you're looking for a guaranteed element in your planning and honing in and really using that filter to find out what guaranteed element you're trying to find in your retirement planning is where we can help.
Absolutely. Again, when you think of the word annuity, think of the word guarantee. And it's just what type of guarantee are you getting? And normally that type of guarantee is then what determines the type of annuity you buy. So if you want a guaranteed fixed rate for an agreed amount of time, you go the MIGA route. If you want a guarantee of principal protection with upside potential, according to the markets, you go the fixed indexed annuity route. If you want a guarantee of income for a period of time, you go the single premium immediate annuity route. If you want a guaranteed lifetime income, but maybe you're going to defer it for a few years, and you want to not have to relinquish control over your principal, then you go the indexed annuity with a lifetime income rider. So you can even get guarantees on long-term care benefits in these products nowadays. So, it's all about the type of guarantee, which then determines the specific annuity type. Remember, there's many types of annuities. We distill it down to 4 types. Not all of them are created equal. All of them have different intended purposes. And it really comes down to then being able to work with someone that can help you decipher, filter, sift and sort, and compare side by side to do the right, thorough analysis to see which one's going to help you achieve your objectives with the highest probability.
Yeah. And really, in just looking at that, there's just not a one size fits all plan. It's a matter of what fits you as an individual. And just because your neighbor found one path that might work for them doesn't mean it's the right path for you. We've talked before, and I've mentioned it again. I think this is the third time in this in this recording where I've mentioned the sleep at night annuity. And that's just what at the end of the day makes you comfortable. It doesn't always equate to the same answer for the person next to you.
Absolutely. So that'll lead us right into our final thoughts. And really, it's all about, don't believe all the hype. Don't fall for the fear mongering. Understand that there's a lot of bias out there that drive people's opinions. And it's really about getting the facts and really understanding a clear, precise way to break down which annuities might fit your goals.
Yep.
And we actually help you with a process, a proprietary process here at our firm that we call the multi-point annuity inspection. And that's where we'll compare and help you compare real time with us on a Zoom meeting, no matter where you're located in the US. We'll connect with you using Zoom, and we'll help you compare the top annuities based on your needs, whether that be guaranteed income. Maybe you have a particular preference on the carrier rating, growth potential, whether or not it has fees or no fees, long-term care features, so on and so forth. And if you're interested in doing that, we would love the opportunity to earn your business. That is how we make a living here at Annuity Association, is by helping people make better annuity buying decisions. We do that through education, transparency, and trust. And we hope that we can earn your business to where you're ready, when you're ready to buy that annuity, that you choose us to hold your hand to and through that process to help you put that annuity in your plan and put that in place. So Zach, any final notes there? Any final thoughts?
No, really just, remembering that in this description, there will be a link. If you want to get a free annuity report, find out if annuities are a fit for you. We've got plenty of content that's accessible on YouTube. We've got plenty of content on our website. So if you do elect to take a free annuity report, you'll have access to some additional education that we provide. Again, at no cost. It's just finding out if an annuity is the right fit for you. So check that out. But otherwise, that's all I've got.
Okay, yeah, to do that, you can go to our website, annuityassociation.com. Right there on the main page, you can request your free annuity report. And then down below there, you can also schedule a time if you'd like to meet with one of our advisors to start this journey on helping you make a better annuity buying decision. So until next time, we are the Annuity Dudes, and we love annuities. Let's hit that music.
Yeah, our new music. This is our vibe.
Yeah, man. What do you want before I done?
That's retirement music.
I just picture somebody laying on the sipping a Mai Tai or
Pina colada.
Pina colada.
There we go.
Awesome. Thanks so much. We'll talk to you soon.